It's time for the Trading Stocks Made Easy podcast. Each week, Trading Stocks Made Easy demystifies stock trading and investing so you can profit big. And now, here's the host of Trading Stocks Made Easy, the wealthy investor, Tyrone Jackson.
I'm Tyrone Jackson, the wealthy investor, and you are back. Welcome, everybody, to another episode of Trading Stocks Made Easy. Now, let's just get to it. You know by now that stocks in the stock market don't always go straight up. Why? Well, there are things that affect the stock price. And I always say, don't buy the stock if you don't understand the story. So today we're going to talk about the tale of two stocks. The first is going to be Disney, who now has that streaming service, Disney Plus. And the second stock I'm going to talk to you about is Netflix and why the shares dropped so radically. The best part about today's show is I'm going to explain all of this to you in layman's terms. So let's get started. All right, what makes a stock price rise in the U.S. stock market? And it's called demand. When we all are reaching for the same company's shares, that drives up the stock price. The difference is you and I might be buying 200, 300, 400 shares at a pop, and institutions are buying what? 3 or 4 million shares at a pop. So it's really institutions like college endowments, insurance companies, and banks that really cause the stock price to rise. Why? Because they're simply buying in greater volume. But we're all responding to the same news. So let's talk about Disney stock first here. In the last 5 years, Disney shares have gone from $115 a share to a high of $190 a share, and then the shares have backed off below $120. Well, I've heard people say about the stock market, it's all luck, and all you're doing is just guessing at what stock is actually going higher. Well, the truth of the matter is, if you have a financial education, you're not guessing at everything. You're following company trends, earnings, and data that the company actually gives out to its investors. So, don't buy one share of stock if you don't understand the story. By that, I mean, if you don't understand how the company actually generates revenue, makes money, and a profit, then you really are guessing. So let's just go through these concepts really quickly. Revenue is kind of like a company's gross earnings before all of their expenses: marketing, advertising, staffing, rent, real estate taxes, etc., etc. On the bottom line of all of that is net profit. Okay, or what the company's actually earnings. So just like when you get your paycheck, there's a gross amount, and then there are these taxes taken out. Well, it's similar in the stock market. Every company has a gross, and then at the end of their balance sheet, what they got to keep. And if there's enough left over, then the company pays a dividend to its shareholders. Got it? All right. Well, sometimes a company can have top-line revenue growth, list its expenses, and at the bottom have zero left over, right? Now, where they're getting that money at from the bottom of the balance sheet to make money is a different issue, different kind of accounting issue. Won't go into that in this episode. But what did we see at Disney? Well, the Walt Disney Company, ticker symbol DIS, has a long-standing history of paying out a dividend. A dividend to shareholders after they've collected the money on all of their movie sales, ESPN, and now their streaming service. But if you recall, in order to finance the streaming service, what did they do? They actually suspended temporarily the dividends to shareholders. Now, when I say they suspended the dividends to shareholders, dividends are your share of the company's profits paid out on a quarterly basis. But generally speaking, who is the largest shareholder at Disney? Well, the company themselves. So when they suspend the dividend, that form of residual income, they're actually taking money out of their pocket, in this case, to finance their streaming service. Well, if you're a bank, insurance company, or a hedge fund, you rely on that dividend as part of your quarterly income. You see, hedge funds, they can have an individual's money who's entrusted $10 million to their care. they love to be able to say to that client who put up the $10 million, hey, don't worry, we'll get you at least a 2% return because Disney pays a dividend. When a company like Disney eliminates or suspends that dividend, that guaranteed residual income is now gone. And that will typically cause a stock to begin to drop. You see, it's all about that financial education and learning how to invest your money. And if you want a guaranteed rate of return, then you have to be looking at what? Dividends. They must be factored into your investing style. So the recent drop that we've seen in Disney shares is due to what? The elimination of that dividend. Well, if you're following Disney and Disney shares, the question is, when are they going to deliver the next dividend? Well, right now, as of today, we don't know. Why? The company is still using the money that they have on the side for shareholders, including themselves in the form of dividends, to pay down debt and grow the infrastructure. Now, on this day, this can all change, but on this day, here's the other problem, the uphill battle that Disney faces, is they're still dealing with lower attendance at their theme parks due to the novel coronavirus. Remember, COVID had a huge impact on Disney's revenue because when you think about visiting theme parks, that means that Disney's in the real estate business, right? And they're charging for entry to the theme parks. Well, if you're not selling tickets, guess what? All that real estate is just sitting there generating zero, and I mean zero revenue. So COVID had a real impact on Disney because Disney is in the entertainment business and the live entertainment business at that. So they also own all of these hotels worldwide. Well, during COVID, was anybody staying at a Disney hotel? Very few people. They also got into the cruise ship business. Do you start to see the ramifications here? Well, if no one is visiting your theme parks or your hotels or your cruise ships, that is hundreds of millions of dollars in revenue that you're simply just not getting. And if you're following your favorite companies on Wall Street, this is an extraordinary time because we all must be following dividend growth, revenue growth, and that bottom line. So over time, Disney will repair all of the ills impacting their long-term revenue. Once those ills begin to be addressed, that's when the stock price is going to go up, and certainly when they restore the dividend. Now, I'm going to talk specifically about certain stocks here and why they continue to rise. If you look at a Dow component like Microsoft, ticker symbol MSFT, why has Microsoft done so well? Well, they're in the software business, right? So whether or not we are in COVID or not, there's revenue being generated from licensing. But Microsoft is very well run, and now they're making billions of dollars from the cloud. So if they're hosting data and they're involved in artificial intelligence, guess what? Whether there's COVID or not, their $1 billion still come in. So if I draw that comparison between Disney and Microsoft, let me ask you a question. What do you think is the stock that's going to hold its own over the next 6 months in a post-COVID world? Probably Microsoft, right? And to use Wall Street terms, Microsoft simply has less headwinds against it than, let's say, Disney shares. So Disney is either going to wait out the revenue decline in a post-COVID world, repair its revenue declines, and restore the dividends, or they're going to buy another company. Now, right now, they don't have the cash flow to buy another company that generates revenue. So I think if you're looking to hold the shares right now, you're going to be sitting in these shares for a while. Now, when we hit a situation like this, there is revenue to be generated through covered calls against your existing shares and setting up bear call spreads. But since this is not a trading class, it's more of an informational show so that you begin to understand how to invest money. I can't go into the strategies that are making some people thousands of dollars a day because the stock is not rising. But I notice that a lot of you who are members of the Wealthy Investor Program really do listen to the podcast. So I'll tell you this. This is the time for Bear Call Spreads, $20 out of the money and 30 days out. For those of you who know what that means, right? Because these shares can become income generators even though the stock is declining. And that's what I love about the stock market. Even when your favorite stocks are going down, there's still money to be made if you know how to apply the right strategy. Now, some of these advanced strategies like Bear Call Spreads on Dow stocks, they take a little while to understand. Trades like Bear Call Spreads work really well as a hedge against share ownership. So if I own shares of Disney, can I still set up these Bear Call Spreads that generate residual income? And the answer is yes. But these are trading strategies that have to be taught. You know how I'm always saying to you, all wealth is taught? Right. So right now, even though these shares are declining, guess what? There are some people, not a lot, but there are some people who are getting really rich off the temporary decline in the shares. So no matter how you look at the stock market, a stock can only do one of three things: go up, go down, or stay the same, right? But if you know what strategy to apply when your favorite stock is temporarily declining, guess what? You can still generate income. But it's all about getting that financial education, because all wealth is taught. Whether a stock goes up, goes down, or stays the same, there's money to be made. Back in a moment.
Want to increase your stock market trading profits? Then you need to start your monthly membership to WITradeschool.com right now. Don't understand how to write covered calls for monthly income? No problem. Simply review Tyrone's latest stock trades in our video library as many times as you need. WITradeschool.com is all about helping you get the financial education you need to earn money in the stock market and change your financial life. Tyrone Jackson, the wealthy investor, has helped his students earn thousands of dollars per month trading stocks online from home. These are people just like you. So what are you waiting for? Follow Tyrone Jackson's red-hot stock trades and investment strategies today. Don't wait. Start your monthly membership at WITradeschool.com right now.
And we're back. Now, today we're talking about why certain stocks are declining and other stocks are holding their own. Well, right now, we're in an environment where the Federal Reserve wants to raise interest rates a half point. The stock market does not like the idea of an interest rate raise right now, even though we have rising inflation. So the market's going to react to that. But don't worry, the market has reacted to increases in interest rates for the past 25 years. It's just that some of you now have a username and password and you can log into your account every single day. But when you had your money and you were giving it to a mutual fund manager, guess what? Your account was going up and down in value every single week. You just didn't know about it. All right, let's talk about Netflix stock, because this is the story that has shocked me the most. Netflix, the leader in online streaming subscriptions, was doing extremely well. In fact, 5 years ago, the shares were trading around $160 per share. Over time, they raced up to $664. And what happened in the last 7 days? Those shares came tumbling down from around $500 a share to below $220 a share. Why would these shares immediately drop so drastically? Well, the answer in wealthy investor terms is don't buy the stock if you don't understand the story. What happened in this last quarterly report? Well, the company revealed that they lost 200,000 subscribers in the last 13 weeks. Now, you do the math. How does Netflix generate revenue? It generates revenue from subscription fees. Well, if you have 200,000 people say, I'm going to cancel that service because I'm already paying for 4 other subscriptions, or I just don't like the content that much, what's happening to the top line revenue? It's starting to show a decline. And although it's early, here's what the market is beginning to opine. That just because you have a subscription service and you're growing your subscribers worldwide, people could cancel if they are not satisfied with the content on your platform. See, we've never seen this before. So shareholders who want to take profits are now dumping the shares because they fear that next quarter there are going to be even more subscribers who abandon Netflix. Now, this story gets really interesting because there'll be some long-term shareholders who'll say, I'm going to hold the stock no matter what, right? But if subscriptions keep declining and they're rising in other subscription services, Wall Street is going, this business model is not that great. Because can't the same thing happen to Disney and Disney Plus? Can't there at some point be people who say, you know what, you are charging me too much and I don't want to hold the subscription here? The answer is yes, yes, and yes. So all of a sudden, investing in Disney shares because you think you're going to get a piece of this online streaming service, well, that might not be the best investment on Wall Street. So when shares drop, there's a reason for it. And I'm sharing with you now that one of the reasons that we're seeing this dramatic drop in Netflix shares and probably will continue to see the shares go lower is because if you keep losing subscribers, the company's top line revenue is going to decline quarter over quarter. And here's the big part, decline year over year. Now, I always say in the Wealthy Investor Program, it's like going on dates. When we buy stocks, we're like going on a date. So think about it. Would you rather date someone whose monthly income is rising? Or would you rather date someone whose monthly income is declining? Now, if you're single and someday hoping to be married, you probably want to date someone whose revenue or monthly income is rising. Why? Because you want a good life with that person, right? You may want to buy a house, a car, take vacations. Well, that's very hard to do with a person who's stunningly beautiful, but earning less money on a month-by-month basis. Do you get that? And if you would not date a broke person in real life, why would you do that with your money in the stock market? So we're in a time in history right now where there are a lot of grand technological advances, but it doesn't mean that all of those advances are going to be profitable if the company that is funding that software or that entertainment platform is losing money. If the company that's funding the technological advances is losing money, that is a bad date. You would never, ever, ever buy that stock. Now, people come up to me all the time and they say, I really listen to your podcast. I love the way you make everything so simple. Right, because I like teaching people how to make money whether stocks go up, go down, or stay the same because I have an inherent love for the stock market. Really, when you get good at investing and when you get even better at trading, market direction, get this, really doesn't matter. What matters is that you know how to make tens of thousands of dollars, whether your favorite stock is up, staying the same, declining, while you're collecting dividends or not. And that's what the Wealthy Investor Program is all about. Remember, if you want to be successful in the stock market, you have to invest in a financial education. If you just leave your money in a mutual fund and hope for the best, well, probably not the most sound strategy in the world, but it might make you feel good. What I want to encourage you to do is get a financial education. Head on over to thewealthyinvestor.net. If you have not downloaded my free ebook, you got to do that. It's totally free. And get to know the principles that can help you make monthly income regardless of the market condition. Now, what I think I'm going to do, because we're going into earnings here, I'm going to highlight a few other stocks during this period so that I can serve a little bit more as your guide through this bumpy period before the market turns bullish. And by the way, there are some people who are buying shares now because once we get past this Fed rate hike jazz, you're going to see a market rally that is strong and swift. And I want you to be ready for it. Hey, it's Tyrone Jackson, the Wealthy Investor, saying thank you for spending this time with me here at Trading Stocks Made Easy. And guess what? I'll see you next time.
You've been listening to the Trading Stocks Made Easy podcast. be sure to rate and review our show on iTunes. While you're on iTunes, be sure to click the subscribe button and you'll automatically receive our next episode.